In the last session, we have started the discussion of the economics questions from the Shankar IS, and today we are going to start from question number 13 because till question number 12 we have already discussed. Okay, so question number 13 here is the question number 13. Which of the following best describe currency demand paradox? Okay, currency demand paradox. The very name is suggesting that there is a demand of the currency but there is a less supply of currency, or maybe be around that there is a uh, huge supply of money but there is a less demand of money. So let us see. Increases in supply of currency exceeding the demand in the economy. Okay, so supply is surplus but demand is not that much. Okay, this cannot happen because you all know that money is something which nobody wants to leave behind. Okay, so that is why this becomes incorrect. Okay, now second, the demand for the currency remains stable despite the inflation effect. The demand for, no, you all know that that whether it is inflation or not, the demand of the currency will always remain high. Okay, so this is also incorrect. So now increase in demand for cash despite increased digital payment transactions. Yes, this could be correct answer. So they have given already. This is the correct answer. That currency demand paradox is what? There is an increase in cash despite increased digital payment transactions. Okay, though your country is having increase in the digital currency transactions, but still there is a need of the cash. Okay, so that is what is the description of the currency demand paradox. And fourth one is a demand for cash due to increased digital payment transactions. So this is incorrect. Okay, so let us see the explanation. Before that, let us make it uh, black. Okay, so that we can easily get what is the correct answer. So currency demand paradox is the increase in demand for cash despite increased digital payment transactions. Okay, now let us proceed with the explanation. So according to RBI, the simultaneous growth of both cash and digital payments is widely referred to as currency demand paradox. So currency demand paradox is a situation where the demand of the cash is also increasing, at the same time the digital and transactions are also increasing. So that is what is known as the currency demand paradox. Since cash and digital modes are generally expected to substitute each other, cash and digital modes are generally expected to substitute each other. The simultaneous rise in both seems counterintuitive. Between 2016-17 and 2021-22, digital payments in India through UPI grew very quickly. The number of transactions increased at an average rate of 50% per year, while the value of these payments rose by 27%. Despite this rapid shift toward digital modes, people continue to rely heavily on cash. Okay, so though there was a increase in the digital transaction noticed in India, but people largely relied on the cash. Okay, you know all better. Okay, why? Because of many reasons. Because India, you have rural population, and in rural people, you know that there is a still significant amount of number of people who are using the cash. Okay, the share of currency in circulation compared to country's GDP went up from about 8.7% in 2016-17 to 10.7% in 2017-18, 12% in 2019-20, and reached a peak of 14.4% in 2020-21 before easing slightly to 13.3% in 2021-22. Therefore, in India, digital payments became more popular, but cash in the economy also kept growing at the same time, which is considered the currency paradox. Okay, so statement C is correct. Now, what is a currency paradox? Let us understand a little bit more into deep into deeper. So about the European Central Bank in 2021 report highlighted what it termed the paradox of banknotes. So paradox of banknotes, it has been highlighted by the European Central Bank in 2021 report. What is this paradox of banknotes? So this refers to the observation that Despite the growing digitalization of retail payments and declining use of cash for everyday transaction, the demand for physical currency has not diminished. On the contrary, the circulation of euro banknotes has been consistently increasing since 2007. The report emphasizes that while consumers are relying more on digital modes of payment in shops and online platforms, many still prefer to hold cash as a source or as a source store of value for precautionary savings and for use in times of uncertainty. This suggests that cash continues to play a vital role in financial system even if its use in direct retail spending has reduced. Now, reasons for currency paradox. So what could be the reasons for currency paradox? So in its annual report, RBI attributes the currency paradox for four reasons. Okay, so it is the official reasons given by the RBI. Okay, so what are these? So first one is the persistent affinity for cash has been attributed to factors such as decline in opportunity cost of holding currency, that is interest rates. Okay, so the persistent affinity for cash has been attributed to factors such as the decline in opportunity cost of holding currency, that is interest rates. Okay, so you know that if you are holding holding the currency, then the interest rate has been, you are not going to get interest rate on that. That is what is the reason. Precautionary holdings and uncertainties. Okay, because of the uncertain things like emergency kind of situation, or maybe you are going at a place where internet is not working. Maybe because of that you need to have certain amount of cash in your hand so that you can do some certain functions of your daily life. Okay, then you have presence of large informal economy, like you have daily vendors across the roads. Okay, who are selling vegetables, for example, vegetables or maybe toys or maybe cloth shops. Okay, so these are things. Then direct benefit transfer by government promoting both cash and digital modes as routing of benefits digital tends to be followed by cash withdrawals. Yes, yes, that is correct thing. So now next, which of the following best describe white label ATM? Okay, white label ATM. Which of the following best describes white label ATM? So what is white label ATM? Let us understand. Okay, so an ATM that exclusively serves customers of a particular bank. No, this is incorrect. This cannot happen because ATM is for almost all the banks, not for exclusively for serving the needs of the particular bank. An ATM that provides services to the customer only for transaction above a particular value. No, this is also incorrect. No ATM can provide such kind of transaction which only limits to a particular value. Then an ATM owned and operated by a foreign bank in which services are restricted to a specific bank holder. No, this is also incorrect. So C is basically the correct answer, which is an ATM owned and operated by a non-banking entity. Okay, so white label ATM is basically this is owned and operated by a non-banking entity, but available for use by customers of all banks. Okay, so a ATM white label ATM is basically a ATM which is basically available for the use of the customers of all banks, but it is operated and maintained and owned by non-banking entity. Now explanation: an automated teller machine ATM is a computerized machine that provides customers of banks the facility of accessing their accounts for dispensing cash and to carry out other financial and non-financial transactions without the need to visit the bank branch. ATMs that are set up on and operated by non-banks are called white label ATMs. White label ATMs were introduced by Reserve Bank of India under the Payment and Settlement System Act 2007 to enhance financial inclusion and expand ATM networks in rural and semi-urban areas. These ATMs are merged and operated by non-banking entities, offering a unique solution to the challenges faced in these regions. Unlike traditional bank operated ATMs, white label ATMs enable customers to perform banking transactions such as cash deposits, then withdrawal and bill payments regardless of which bank they hold an account with. White label ATMs provide essential banking services but typically charge a minor fee for card issuance and transaction facility. So statement C is correct. Now additional information: types of ATM level recently in news. So RBI grants white label ATM license to Mumbai West EPS. Yellow label ATM. So yellow ATM ATMs are tailored to support online shopping and e-commerce related financial transactions. Okay, so features: allow payment for online purchases, facilities management of other e-commercial financial needs. Then it supports integration with digital payment platform. Uses: convenient for customers who shop online and need a seamless way to handle e-commerce payments. Okay, then you have green label ATMs. Okay, so you have yellow for online transaction, white is something which is on by the non-banking entity. Okay, then you have green label ATM, so ATM that are designed to cater the financial needs of agriculture sector. Okay, so green label ATM, it is related to agriculture sector. Okay, supports transaction related to agriculture subsidies and farming, enables withdrawals from accounts linked to agriculture benefits, provides a user-friendly interface for rural users, uses beneficial for farmers, agriculture workers seeking easy access to funds and government subsidies. Then you have pink label ATMs, designed to prioritize the safety and convenience of women. Features: located in secure areas with enhanced safety measures, tailored to increase independent banking by women. User-friendly interface for a smooth experience. Uses: encourages women to engage in banking services independently, especially in areas with security concerns. They are monitored by security personnel to ensure safety. Then you have brown label ATMs. Brown label ATMs are operated where ATM hardware and leases are owned by a third party service provider, but cash management and connectivity to banking networks are provided by a sponsor bank. Ownership and operation: the service provider owns the ATM machine, arranges for its placement, and manages the infrastructure. The support sponsor bank provides the cash and network connectivity. Features: banks manage branding and cash. Service providers handle installation, maintenance, and technical support. Expand ATM network without logistical strain on banks. Uses: efficient for banks looking to expand their ATM presence cost effectively. Now, next question. Consider the following pairs, and now we have to just identify whether they are correctly matched or not. So, what is fiscal deficit? So, you all know that fiscal deficit is basically about the it highlights the borrowing requirements of the government. So, it is a measure that suggests the total borrowing requirements of the government. Okay, yes, correct. So fiscal deficit, you know that this is the nothing but the your export minus import. Okay, so that is nothing but the borrowing requirements of the government. Then we have revenue deficit. It indicates the excess of government revenue expenditure over revenue receipts. Yes, correct. Primary deficit, it highlights the present fiscal imbalance and is measured as fiscal deficit minus the interest liability. Yes, this is also correct. So all of them are correct. Now let us see the explanation. In simple terms, deficit occurs when government spends more money than it collects through various sources of revenue, such as taxes. A high deficit can indicate an unstable economic situation and signal potential financial challenges for a country. Now, fiscal deficit, it occurs when government's total expenditures exceed its total revenue, excluding borrowing during a fiscal year. Okay, so fiscal deficit when the government expenditure exceeds to the total revenue of the government during a fiscal year. In simpler terms, it represents the total borrowing requirements of the government to bridge the gap between its expenses and revenues. Okay, a high fiscal deficit often stems from excessive or unnecessary government spending. Formula: fiscal deficit, you have total expenditure minus total revenue receipts plus recovery of loans plus other receipts. So pair one is correct. Now revenue deficit. It occurs when the government's total revenue expenditure exceeds its total revenue receipts. It reflects a shortfall in the regular operational revenue to meet day-to-day expenses. Revenue receipts consist of tax revenues and non-tax revenues, a state share of union taxes and duties, and grants and aid from the government of India. A high revenue deficit indicates that government is spending beyond its means for routine operations, potentially requiring borrowing or asset sales. This can lead to inflation and increase the country's debt burden. Formula: revenue deficit. Revenue deficit is the total revenue expenditure minus total revenue receipts. Now, primary deficit, it refers to the fiscal deficit, fiscal imbalances of the current year, excluding interest rates on the previous borrowing. It highlights the government's borrowing needs without accounting for fast interest liabilities. Monitoring the primary deficit is crucial for assessing a government's ability to meet its financial obligations and manage its budget effectively. A sustained primary deficit over time can indicate fiscal imbalance and may lead to increased borrowing, higher debt levels, and potential economic instability. Formula: gross primary deficit is equal to gross fiscal deficit minus net interest liabilities. Net interest liabilities consist of interest payment minus interest receipts by the government on net domestic lending. So pair 3 is correct. Now next, which of the following is the common characteristics of wholesale central bank digital currency and retail central bank digital currency? So digital currency, you know that central bank digital currency, there was a UPSC previous question already there. So let us see. It can be used for person to person payment. No, it has no denomination. Yes, no, sorry, no. So it is also incorrect. It has a domination. It can be used for, it cannot use for person to person payments, means hard in the hard form. Okay. It is an account based CVT. This is also incorrect, so none of them are correct. So let us see the explanation. So central bank digital currencies are digital versions of the country's official currency issued and regulated by the central bank. Their value is fixed by the government. Value is basically fixed by the government, making them stable and government backed forms of money. For example, digital rupee, e-rupee, issued by Reserve Bank of India. RBI is India's central digital currency, representing the digital form of the physical Indian rupee. There are two types of central bank digital currency in India. First is a wholesale central bank digital currency. It is designed for financial institutions and intermediaries. This is used for interbank settlements and large value transactions. It operates within a restricted ecosystem and leverages technology like smart contracts to improve the efficiency, speed, and security of the wholesale payment system. Then you have retail central bank digital currency intended for general public. Retail CBDC can be used for everyday transaction. It enhances everyday transaction. It enhances accessibility, financial inclusion, and convenience, allowing individuals and businesses to use digital currency in place of physical currency. So statement 2 is not correct. CBDC are a full form of digital currency denominated in the national unit of account, which is a direct liability of the central bank. CBDCs can be designed for use either among financial intermediaries only or by the broader economy, that is retail CBDC. So statement 2 is not correct. Now CBDC can be structured as a token based or account based. A token based CBDC is a bearer instrument like bank notes, meaning whoever holds the tokens at a given point in time would be presumed to own it. In contrast, an account-based system would require maintenance of a record of balances and transactions of all holders of the CBDC and indicate the ownership of the monetary imbalances. Considering the features offered by the both forms of CBDCs, a token-based CBDC is viewed as a preferred mode for CBDC, that it would be closer to physical cash, while an account-based CBDCs may be considered for CBDC W. So statement 3 is not correct. Now, additional information: central bank digital currency. So the value of India's central bank digital currency, or e-rupee, rose sharply from 234 crore in March 2024 to 1016 crore by March 2025, according to the Reserve Bank of India, RBI. The RBI also stated in its annual report that it is exploring pilot projects for using a CBDC in cross-border payments, though no timeline has been announced yet. Reserve Bank of India broadly defines CBDC as the legal tender issued by central bank in, so it is basically legal tender issued by central bank in the digital form. It is akin to sovereign paper currency but takes a different form, exchangeable at par with the existing currency, and shall be accepted as a medium of payment, legal tender, and a safe store of value. So cash but digital. So this is the official logo of the India's central bank digital currency. Okay, so this is the official logo. Now, growth of India's CBDCs. India's central bank digital currency (CBDC) or e-rupee was first introduced in November 2022, starting with a wholesale pilot and later followed by a retail pilot. One of its main goals is to simplify cross-border payments and address challenges posed by non-fiat digital currencies like Bitcoin. The Reserve Bank of India (RBI) is also considering participation in multilateral CBDCs initiatives, especially under the Bank for International Settlement (BIS) Innovation Hub. The RBI aims to expand the scope of ongoing pilots, both retail and wholesale, by introducing new use cases, features, and technological improvements, including enhancement to the account aggregator framework for better transparency, convenience, and efficiency. As of March 2025, the total e-rupee in circulation reached rupees 1016 crore, with the majority 857 crore in 500 notes, followed by 291 crore and 138 crore denomination. The retail pilot has expanded from initial person to person and person to merchant use cases to include offline transactions and programmable features. To boost adoption, central non-bank entities have also been allowed to offer a central bank digital currency. The wholesale central bank digital currency pilot has been expanded and diversified with the addition of four sandstone primary dealers, improving the efficiency and reach of large value and interbank transactions. Now you have certain things parameter and CBDCs. So difference between these two. So let us quickly look at this. So UPI, so what is unified payment interface? It is a real time payment system that transfers money from one account to another instantly. It is not a digital rupee, but a facilitator of the transactions. Okay, whereas CBDC or e-rupee is akin to sovereign paper currency. A wallet is loaded with e-rupee, which can then be transferred to another wallet. Now, dependency UPI transactions happen between bank accounts, and hence they are dependent on banks, the National Payment Corporation of the India, and PCI, and the payment service provider PSPs. Central bank digital currency wallet is independent of the bank account, and transaction can happen using the wallet balance. Okay, when a payer makes a UPI payment to pay, the transaction follow involves the NPCI payer, bank payee, bank payer, and PSP and payee PSP. When a payer CBDC wallet scans or adds details of payee CBDC wallet, the money is sent from one wallet to another, cash balances without any involvement of third parties. Settlement for end users happens instantly, as the money gets immediately debited or credited. However, interbank settlement occurs on a deferred net basis. There is a no settlement, as the wallet balance gets transferred to another wallet. UPI transactions are recorded by banks and reflected in the statement. Anonymity is the key feature. Anonymity is the key feature of the central bank digital currency. No data is captured on transaction from one wallet to another. uh, UPI, when a pair makes a transaction through UPI, the money gets debited from the pair's bank account and credited to pay. This gets reflected in both bank statements and the bank's ledger, making it anonymous. During CBDC's wallet transaction, there is a no dependency or intermediation by bank. This implies that the transaction will not be recorded in the statements, making it anonymous. This is true for all transactions lower than the 50,000 rupees. Liability lies with the users and the bank accounts. Liability lies with the central bank, that is the Reserve Bank of India. Okay, so I think how many questions we have done with so far? One, two. So we have started from here. So 1, 2, 3, this one 4. So 4 questions so far we have been able to understand. Okay. Now question number 17. Consider the following statement: a positive value of net international investment position NIPP reveals that a country is a creditor nation. Yes. Why? Because you have positive value of net international investment position. Okay, means that in international means that FDI is coming. Positive value means the FDI is coming in a country. Okay, which means that the foreign capital is coming uh, much than it is going outside. Okay, so that is means positive. So it is correct. The NIIP measures the gap between a nation's stock of foreign assets and a foreigner's stock of that nation's foreign. Yes, correct. So all of them are correct. And second, explain the one. So this is correct answer. Let us see explanation. Oh. So a net international investment position NIIP measures the gap between a nation's stock of foreign assets and a foreigner's stock of that nation's assets. It can be viewed as a nation's balance sheet with the rest of the world at a specific point in time. An IIP is an important barometer of a nation's financial condition and credit worthiness. A nation with a positive NIIP figure indicates that the domestic nation's ownership of foreign assets is greater than indicate that the domestic nation's ownership of foreign assets is greater than the foreign nation's ownership of that domestic nation's asset, thus making it a creditor nation. An IIP includes overseas assets and liabilities held by a nation's government, the private sector, and its citizens. The NIIP is analogous to net foreign assets, which determines whether a country is a creditor or debtor nation by measuring the difference in its external assets and liabilities. Now, additional information: net international investment position. So, NIIP is in news amidst the global tariff war, mentioning the US has the largest negative net international investment position. NIIP financed by global capital as this rebalances the dollar may weaken. About in the NINIP assets are divided into direct investment, portfolio investment, and other investment and reserve assets, which include foreign currencies, gold, and special drawing rights (SDR). A negative NIIP figure indicates that the foreign nations own more of the domestic nation's asset than the domestic nation does of foreign assets, thus making it a debtor nation. India's net international investment position NIP is a negative with minus 348.501 US dollar in US dollar billion in September 2024. Now next question, which is question number 3. Consider the foreign reserves. Arrange the above given foreign reserve of India in the increasing order of their value using the codes. Okay, so increasing value. So increasing value we have to see. Okay, so the highest one is the increasing value means ascending order. Okay, so how we will be doing? So first of all, we will list out which is the highest with India. So India holds highest, that is the foreign currency assets. Okay, so this will be last. So you have 4 at last. This is incorrect. Okay, this is incorrect. Why? I told you because 4 is monetary with IMF. So this is incorrect because India is having highest. What is this? This is the foreign currency asset. Then 3 cannot be true. 4. So only D is the correct answer. Okay. So just guessing one thing, we get the just knowing one thing, we are able to understand the or get the correct answer. Okay, so IMF, with IMF you have list. So 4 is first, then you have SDR, then you have gold, then you have foreign currency assets. Okay, let us see now. explanation. So foreign exchange reserves are assets denominated in foreign currency held by a central bank. These reserves are used to back liabilities and influence monetary policy. As per Reserve Bank of India, foreign currency assets, the largest component of the reserves, declined by $846 million to $586.15 billion. Foreign currency assets are maintained in major currencies like US dollar, euro, pound sterling, Australian dollar, Japanese yen. Foreign currency reserves are dominated and expressed in the US dollar only. Both the US dollar and euro are intervention currencies. Gold reserve were up $360 million, standing at $92.78 billion. Special drawing rights were up by $105 million to reach $18.88 billion. SDRs are international foreign currency exchange reserve assets allocated to nations by the International Monetary Fund (IMF) and SDR represents a claim to foreign currency for which it may be exchanged in times of need. Although denominated in US dollars, the nominal value of the SDR is derived from a basket of currencies, in this case a fixed amount of Japanese yen, US dollars, British pounds, a basket of currencies, in this case a fixed amount of Japanese yen, US dollars, British pounds, and euros. SDRs are the IMF's unit of account and are denoted with the ISO 4217 currency code. India is now India's reserve range position RTP with the International Monetary Fund (IMF) was up by 2 million dollar at 4.76 billion. The primary means of financing the IMF is through members' quotas. Each member of IMF is assigned to a quota, a part of which is payable to SDRs or specified usable currencies, reserve assets, and part in the member's own currency. The difference between a member's quota and the IMF's holdings of its currency is country's reserve tranche position (RTP). Therefore, foreign reserves of India arranged in increasing order of their value are as follow. Okay, now additional information: foreign exchange reserves. So foreign exchange reserves can include banknotes, okay, deposits, bonds, treasury bills, and other government securities. They mainly serve as backup funds for a central government if its currency loses value or becomes insolvent. The reserves of most countries are in US dollars. China holds the largest amount of foreign currency reserves globally. Reserves are crucial for stabilizing a nation's national currency, supporting monetary policy during economic uncertainties. India's gross foreign exchange reserves comprise foreign currency assets of the Reserve Bank, gold held by RBI, special drawing rights (SDR) of the Government of India. India's reserve position in the International Monetary Fund is not included as uh, part of the foreign exchange reserve, as they may not be available on immediate demand. Although some countries do include these balances as part of their reserves. Importance: currency stability, smooth international trade, crisis management, and boost investor confidence. Okay, support debt repayments and emergency funding. Now moving to the next question. Question number 19. Consider the following statements. The merchandise trade deficit of India has been consistently increasing for past 5 years. Merchandise trade deficit of India. Merchandise means the traders who are taking the loans. Okay, yes, that is correct. Now the merchandise imports of India have been consistently increasing for past 5 years. We are importing more. So but they are saying that consistently increasing, so consistently increasing for past 5 years, which means 2015 to 20. No, that could be incorrect, that will be incorrect, so both of them are incorrect. Why? Because in 2020 to 21 there was a COVID-19, okay, because of which it has declined, it must have been declined. Okay, so both of them are incorrect, so not correct, so both of them are not correct. So now see the explanation. A trade deficit occurs when a country's imports exceed its imports. A trade deficit is also referred to as negative balance of BOT. The balance can be calculated on different categories of transaction and goods, also known as merchandise, services, goods, and services. Balances are also calculated for international transactions, current account, capital account, and financial account. India's merchandise trade deficit during financial year 2014-25 stood at itna compared to its in so this much. Meanwhile, India's merchandise imports in April amounted to this is reflecting an increase of 55% over and rise in India's merchandise consists of export of goods. Uh, Therefore, merchant trade deficit of India has not been consistently increasing for the past 5 years. Okay, so this is the thing. So I think now it's clear. So this is the India's merchandise trade deficit. So it is not increasing. So you have see here you have jump. It is increasing, but it has seen a dip. Now again dip. Okay, and again increase. So that is what is happening. So not consistent. We can say trade deficit of merchandise of India. Similarly, this is also imports. Okay, so you have 2020, 1920. You see 474. Then you have dip. Okay, during COVID-19, then suddenly increase, then increase, then again dip, then again increase. But this is how it is going. Now next, which of the following can reduce the current account deficit of a country in the BOP balance of payments? Okay, so current account deficit. First of all, we should know. So current account deficit. Okay, so reduce remittances from abroad. No, if you reduce the remittances, then what will happen? Then the current account deficit will increase. Okay, so this is incorrect. This cannot be the correct answer for us. Let me just mark it black. Increased foreign direct investment. Increased foreign direct investment. Okay, can reduce current account deficit. Okay, we have to reduce the current account deficit. Okay, increase foreign direct. See, foreign direct investment is coming in your country, which means that they will. You have to. The foreigners who are investing in India, they will be getting something from you. Okay, so it may or may not increase the current account, but increase tourism services will certainly increase the what you call the will reduce the current account deficit. Okay, so 3 is absolutely correct. However, we if 2 is not correct, so C is the correct answer. Now see the explanation. A country's current account is its record of flow of money into and out of the country in the form of imports and exports, investment earnings, and foreign aid. The level of country's current account surplus or deficit has an impact on its employment levels, economic stability, and more. A current account deficit CAD occurs when the total value of money flowing out from imports, payments, etc. is greater than the total value of money flowing in from exports, earnings, etc. Conversely, current account surplus means a country is earning more than it's spending internationally. India manages its current account deficit through a mix of monetary, trade, and structural measures designed to keep the rupee stable and external finances resilient. The Reserve Bank of India (RBI) remains central to this strategy, intervening in currency markets when needed and maintaining over $650 billion in forex reserves as a cushion against global volatility. Now, on the government side, policies target both imports and export to reduce the current account deficit, including import cuts, import curbs, duties or restrictions on non-essential goods like gold, electronics are often introduced during high deficit periods. Export promotion incentives and scheme promoting IT, manufacturing, and high value sectors help improve the trade balance. Alongside export promotion schemes such as the production linked incentive PLI schemes aim to reduce import dependence. Bilateral trade agreements diversifying export markets reduces a reliance on a few trading partners. Remittances policies increasing inflows from non-resident Indian NRIs provide a steady stream of foreign exchange. Schemes such as NRI deposit scheme bank account encourages remittance that provide attractive interest rates, repatriation benefits, and tax advantages. In financial year 2024-25, inward remittances, private transfers by overseas Indians hit US dollar 135.646 billion dollar, a record high up to 14 around 14% over the previous year. So statement one is not correct. Now, foreign direct investment (FDI). FDI is a stable source of foreign capital that can help to finance the capital account deficit. Tourism foreign exchange earnings through tourism were 28 billion US dollar into financial year 2023. Tourism contributes to reducing the current account deficit. So statement 3 is correct. Now it is an information balance of payment. The balance of payments for a country can be defined as a systematic record of all the transactions between the economic units of one country, such as households, farms, and government, and rest of the world in a given period of time. This includes all transaction records made among the individual corporates and the government, and helps in keeping the flow of funds on track to develop the economy as a whole. Components current account. The current account in the BOP comprises the transactions in goods and services alongside transfers during the current time period. Current account value of exports minus value of imports. Now capital account, the capital account records all transactions in assets. An asset may include any of the types in which wealth can be held, for instance stocks, bonds, government debt, etc. Purchase of an asset records a deduction in the capital account. If an Indian is purchasing a US car company, then it is recorded as a debit in the capital account of India. Okay, so all these things you can see in the NCRT. Okay, now next question. Consider the following statements. Okay, so this will be the last question for today's discussion. Okay, no further discussion anymore. So this will be the last. Okay, just one page more. Explanation. The real effective exchange rate (REER) is a measure of comparative health of country of a nation's currency against the currencies of nations it trade with. Okay, so real effective no, questions we have to look at first. An increase in the value of REER denotes a decline in the trade competitiveness of the country. Yes, correct. REER measures the value of domestic currency of the major trading partners. So this is incorrect. So C is the correct answer. Okay. Now let us see the explanation. So REER is the nominal effective exchange rate. So all these things. Real measures the value of home country's currency relative to a basket of its trading partners' currencies, adjusted for relative prices and cost. Okay, so what is this? So this is what. Now there are certain things we will be doing next.